All right, it's 11 o'clock. Welcome, everyone. We're going to get started right on time. Good to see so many of you on the call. Welcome to the Lumsden and McCormick webinar series, Sweeping Legislative and Accounting Changes. This is part 4, IRS Audit, coming soon near you. I'm going to put a few things in the chat right now, and it is about our upcoming webinars as well as some other notes, and we'll go through those. Before I get to introductions, I just wanted to go through a few housekeeping. My name is Maria Gambacorta, for those of you who don't know me, and I'm going to host the webinar here today. I'm the marketing director here at Lumsden and McCormick. So this webinar will be recorded shortly. After this session, we'll put the slide deck along with the recording on our website. It links to the YouTube, our YouTube channel, where you can view a recording if you want to refer to it after. Both the chat and the Q&A features are enabled on this webinar. So if you have a question for me, you can put that in the chat. Any technical question for Michie or Sarah, if you could please put that in the Q&A. We're going to hold all the questions till the end of the webinar. So as you think of them, put it in the Q&A section, and then we'll get to them. We'll do our best to answer all the questions, but we also want to be respectful of everyone's time and keep the session to 1 hour. So moving on to CPE, we are offering 1 hour of CPE credit for this webinar. Therefore, all polling and survey questions need to be answered. We have 4 polling questions. You're required to answer 3 in order to earn CPE credit. You'll be prompted for each, and there is also a short survey at the end of the webinar that automatically launches. If you could please fill that out, that's also required for those requesting CPE. And the CPE certificates come from Lumsden and McCormick, but we have a online software system that does that, and I put the email in the chat. It's from support@polera.com if you want to make sure that is in your contacts. That way you'll be sure to get your email certificate. I did mention that that this is a 6-part webinar series. This is part 4, and parts 5 and 6 are on our website, and you can see the link in the chat to access the other events. So now we're going to get to our presenters, Sarah Hopkins and Michie Needham. They are going to share with us their experiences with IRS audits. From the tax division, from the audit division, partner Sarah Hopkins and the tax department partner Michie Needham. Sarah primarily focuses on accounting, auditing, and tax matters related to nonprofit organizations and governmental entities. Michie's focus is in tax and advisory services for commercial businesses and individuals, and she has an expertise in partnerships, S corporations, and personal taxation. So both Sarah and Michie's bios and email have been sent in the chat, so you can reference those. They're also in the emails that were sent out as well. So before I turn it over to Sarah and Michie, we're going to launch our first poll. And that is, if you guys want to advance the slide to so they can see the poll. But the first question is an easy one. It's, are you attending this webinar to earn CPE credit? If you want to just fill that out, and I'll give it a few seconds, and then Sarah and Michie will get started with the presentation. Usually give each question about 30 seconds. Which is a lot longer than you think. All right, I'm going to end the poll now, and then we'll turn it over. Thanks, guys.
Thanks, Maria. Well, good morning, everyone. Thank you so much for joining us. As many of you are aware, it is anticipated that the number of audits is expected to increase significantly in the near future. So to help you prepare for the possibility of an audit, we've put together a presentation to cover the following topics. We're going to provide you with the IRS tax audit history and statistics. We'll go over the types of IRS tax audits. We'll help you learn how to prepare for an audit, how to manage the IRS tax audit process, and leave you with some tips for a successful IRS tax audit. I am going to now turn it over to Mishi to get us started with the history and statistics.
Good morning, everyone. Thanks for joining us today. First and foremost, I'd like to start off by letting everybody know the IRS actually does have a mission statement, and it's not to screw over taxpayers. It's actually to provide America's taxpayers top quality service by helping them understand and meet their tax responsibilities and enforce the law with integrity and fairness to all. That being said, we're going to go over some statistics in which we're going to show you why there's a need to increase the enforcement and audit from the IRS. So we're going to start with this slide here, and most of this data comes from the Internal Revenue Services data book for their fiscal year of 2020, which is from October 1st of 2019 through September 30th of 2020. Now, these statistics are a culmination. It's not just specifically for a 2020 tax year or specifically for the 2019 tax year. So this is just whatever ended up in that fiscal year. So to start off with, what does the IRS actually expend in a fiscal year in terms of what their overall budget is? So for fiscal year 2020, the total expenditures of the IRS were $12.3 billion compared to $11.8 billion. As you can see from the graph below, that is significantly less from 2011. There was a slight bump up from 19 to 20, and some of that bump up has to do with COVID-related assistance that was provided. So as you can see, over the years, there's been a 14% decrease from 2011 to 2020 in terms of overall expenses. And how are these expenditures used within the IRS and what functions? So the top amount of expenditures is spent on enforcement. So $4.8 billion of enforcement for activities that are related to determining and collecting taxes that are owed, providing legal and litigation support, especially if there are claims that need to go to court by taxpayers and the IRS, and also to conduct criminal investigations in all related matters to make sure that all taxpayers are paying their fair share of tax. The next highest expenditure is operation support at $4.5 billion. And this is basically the support that's provided to the taxpayer services arms of the IRS and the enforcement programs. So these are just basically overhead expenditures. As you can see, that's a pretty big piece of the pie. Taxpayer services, there's about $2.7 billion spent there. And that's related to pre-filing assistance and education for taxpayers, filing and account services, and taxpayer advocacy services. Being a tax professional, we definitely use taxpayer services a lot. It's been very difficult to get through these days to the point where you don't even get to be put on hold. They just hang up on you and you just have to keep redialing. So we could definitely use some more funds in that area and some more employees to help us out with those situations. And finally, the smallest part of the pie is the business systems modernization, which are funds used for capital acquisition for information technology. So this would be computer programs, artificial intelligence, things that the IRS can use maybe where they don't need as much human capital involved, but more specifically, their programs and e-filing looks as though we could probably spend a little bit more in that area as well. Our next slide provides us some information on how many individuals does it actually take to run the IRS. Currently, there are about 76,000 full-time equivalents, which is a 20% decrease from 2010. This is moved up slightly from 2019 to 2020, but they did onboard some additional employees to help with all the COVID relief and programs that have been rolling out since that time. A large portion of the employees that have left the IRS are more retirees than it is from budgetary constraints. and it is difficult to replace those that have retired. And based on the previous slide, there's not been a large investment in artificial intelligence to replace the human capital from these employees that have left. Overall, in fiscal year 2020, the IRS had gross tax collections of $3.5 trillion. Now that's gross, so that's before any refunds were issued. There was about $303 million of refunds issued out of the gross tax collections. And if you understand how the IRS works, generally speaking, your refund is on the honor system, and then at some point in time, if they want to audit you, that comes anywhere between 12 and 18 months after you may have received a refund. How does all of this add up? Where are all these trillions of dollars of taxes coming from? So the individual sector, $1.8 trillion of income taxes. This is income tax withholdings and estimated tax payments made by individuals. It also includes estimated tax payments made by trusts and estates, even though way at the top of that graph there, you do see estate and gift taxes. Those are actually the income taxes that were filed on returns versus just the estimated payments in that green bar below. Employment taxes, $1.4 trillion of employment taxes. So these are any withholdings and self-employment taxes that have been paid in that are not federal income tax withholdings. So your FICA, your Medicare, your unemployment taxes are there. Very, very small piece of the bar there is for business income taxes, $2.6 billion of business income taxes. This number is made up of corporate income taxes and also taxes collected from tax-exempt organizations, unrelated, or UBIT, so to speak. And the UBIT collected from tax-exempt organizations is shy of $1 billion. So there's not a big piece of the pie there either in terms of tax collections. Excise taxes make up about $72 billion of the total $3.5 trillion. And there's just a very small piece that's collected from estates and gift taxes. So how does this all work? How does the IRS determine once someone has filed their return, how many collection efforts do they need? What are how do they recommend and what actually do they collect in after individuals and businesses have filed their returns? So on the left side, you see a bar in terms of what are the compliance activities. So there was about 3.5 million notices issued, audit notices, collection notices issued from the IRS in the fiscal year 2020 with a recommendation of additional tax assessments of $22.4 billion. Now, the key word there is recommended. A lot of these recommended additional tax assessments generally are contested by taxpayers or the tax advisors of the taxpayers and may go down from the $22.4 billion. So because those cross fiscal years, it's hard to really estimate of that $22.4 billion of a recommendation, how much they've actually collected. But what's important to know is how does this happen? What does this mean? Is it just an audit? How does the IRS go after those who aren't filing their taxes? Maybe there was some math errors. So on the left side of the slide there, you'll see what are the activities. So by far, if you look at the graph there, field examinations, which are also office examinations, and Sarah will touch on this in a little bit. Those are actual audits that are going to occur that involve an IRS agent face-to-face. Your correspondence examination is also another term for an audit, but that is through correspondence with the IRS. You may have a phone interview, but you may not have an actual auditor in your office or your accountant's office. An automated underreporter notice is this: the IRS is using their computer systems to analyze tax returns and data that they receive from third parties to match up to say, hey, this is what everyone told us that they paid to you, and this is your tax return. We see some discrepancies here, and we're going to give you a chance to tell us whether or not you may have unreported your income based off of what we have. So this is where it's very important to really look at those, the information that you are receiving from third parties to make sure it's accurate, because if it goes to the IRS, that's what they're going to match your tax return up to. And then there is the automated substitute for a return. And these are notices that are generated for individuals and companies that just aren't filing a tax return. So the IRS is using all of their database of information from third parties, they're nicely generating a tax return for you to let you know that you need to file and that you owe money. You're not going to get a notice if they generate a tax return for you and you're supposed to get a refund. They don't do that. If you're owed a refund and you've not filed your tax return, you actually have to file a tax return to get that money back. So that's what the substitute for a tax return is. A large part of this is math errors, which is surprising to me because I would say most tax returns are filed using software. So this is where I would make the recommendation that if you are using a software, whether it's a TurboTax, even sometimes here at the firm, we have to make sure that all of our updates are accurate, on time. Things change over the course. We've seen this through this tax season where there was legislation that's been passed in the middle of tax season that affects our tax returns, and you want to make sure those calculations are right. And a very, very, very minuscule part of that are tax-exempt examinations, and that doesn't just include nonprofits, that includes retirement plans, any type of information return or tax return in which there is no income tax essentially due. So what does this all mean? The Biden administration feels that allocating additional funds to the IRS to reduce the tax gap will help enforcement programs to increase and generate more revenue, tax revenue that's needed. And over the course of right now, the bipartisan infrastructure investment plan, or also it's out there called the framework plan. It wants to allocate $40 billion to the IRS over the next decade. And they estimate that $40 billion will generate another $100 billion in net new tax revenue. There's a lot of skeptics out there saying that data just doesn't match up, that it may not be possible to generate $100 billion based off of this infusion into the IRS. One of the reasons is that Biden is targeting wealthy taxpayers. Well, you'd have to assume that the wealthiest of taxpayers have a whole team of tax advisors and tax attorneys that are making sure that their positions are on point to what the tax law says. And that takes a lot of effort to really squeeze the extra dollars out of those individuals. But what's interesting is that currently the IRS is ramping up their small business units. So they're not just targeting wealthy individuals and large corporations. By the end of September, they're supposed to be adding 2,000 new workers to the small business unit. And the criminal investigation division is being pumped in with another 500 workers this year and probably another 250 next year. So that's what's happening currently. So it's not just the large and wealthy that they're looking at. The other issue with all of the new employees is really the training of them. And you're not going to be able to train a one-year IRS agent to go into an audit for an individual that's taking very, very sophisticated tax positions on their tax returns and having that be a successful audit for the IRS. And one that's very near and dear to my heart, since I am a partnership kind of gal, is this Bipartisan Budget Act of 2015, or the BBA. So back in 2015, the IRS finally recognized the fact that they really need to start finding a more efficient way to audit partnership returns, where many of the mid to small size businesses are partnership flow through entities, and those individuals report the tax on their returns. It was a very antiquated process in terms of them trying to get to auditing a partnership and then having to find all of the returns related to it on an individual basis and then go and audit them. It could take them anywhere from 24 to 36 months just to audit one partnership return. So since 2015, the IRS has been doing a great job of making the tax professionals prepare these partnership returns in a way to make it much easier for them to be able to come in and audit the returns. And then what will happen is that the IRS will be able to audit at the partnership level if you are required to be in the audit regime, and also assess the tax at the partnership level. This could be an 8-hour CPE within itself, so I'm just going to leave it there. In terms of partnerships, we will be seeing a lot more audits going forward. We do have ways to push it out to the partners if necessary, but this is definitely a hot place where the IRS is going to start auditing. And from there, I'm going to hand it over to Sarah, who's going to talk about the tax-exempt and government entities.
Okay, thank you. So there is a division of the IRS that is specifically dedicated to tax-exempt and government entities. And as Ms. Shee had indicated, tax-exempt doesn't just mean your nonprofit organizations. It does also include governmental entities and employee benefit plans. So it would be those types of entities that are not typically required to pay an income tax or subject to income tax. So what this division does each year is they establish a work plan. The work plan, they have their own dedicated space on the IRS website. So it is public information. So they talk about what they plan to do. And then they also issue an accomplishments letter each year. So they're telling the public, this is what we were able to accomplish. So in the 2020 accomplishments letter, they noted that they added 188 people during 2020 to bring their staffing to just over 1,600 people. They completed examinations totaling 3,240. So of these returns, so that's going to include your 990 series. So that's anything from the 990N, or what we refer to as the postcard, all the way up to the regular or full 990, as well as the 990 for private foundations and certain trusts. It also includes associated employment returns, and as I mentioned, the excise tax returns. 88% of the closed examination resulted in a tax change. And we'll get into some more tips and areas of where you could end up with a tax change when we're talking about tax-exempt organizations. In this, of those that were concluded, there were 36 entities that were their exempt status was revoked based upon this work that they're doing. So at this point, I believe it is time for another polling question. So which type of IRS tax audit have you, your business or organization, been subject to?
We've still got about 5 or 6 people that need to complete the poll. I want to make sure they get their CPE credit, so we'll give it another few seconds. Sarah, would you like me to share the results?
Yes, please.
Okay, so I'm going to end the poll and we will share the results.
Oh, that's wonderful. So it looks like 62% have not been subject to an IRS audit. And those others, the correspondence, the office, and field. Next, we're actually going to talk about what those would have looked like to you. Okay, so IRS tax audits and compliance checks. So Ms. Shee had talked about this when she was going through the statistics of the different types of tax audits that there are. So the correspondence audit is actually the most common. What you would expect is that you would receive a request for additional information from the IRS. This information is requested to be mailed, and it doesn't typically require meeting with an IRS agent, at least at this level. An office audit is where you will be requested to visit an IRS office. You will meet with an agent there. So this happens when they have questions about your return. So it would be something that is too complex for them just to request information to be spent in, but it's not significant enough to warrant a full field audit. Now, a field audit, this is the most comprehensive and invasive audit that you can be subject to. This is where an IRS field agent will conduct the audit at your home or business. If they are going to your business, they will ask, and your home, they would ask to examine records. They will conduct interviews. And if they were on site at your business, they may be touring the facilities. So the interviews may be with multiple people within your organization, and it would include your accounting staff, and they would be asking questions to understand the sophistication of those individuals. And again, this is a very invasive process for someone to go through, but we're going to give you some tips on how to be successful for this and how to plan as we get a little further into the presentation. Now, there's also something called a compliance check. It's not an audit because it doesn't directly relate to determining a tax liability for a particular period, but it does require a review of information and forms that are required to be filed or maintained. And it can also include an assessment as to whether or not an organization's activities are consistent with its stated exempt purpose when this relates to a tax-exempt organizations. It typically begins with a questionnaire being sent to an organization. You're requested to respond to the questionnaire and send it back. So it's called a voluntary questionnaire, but it would be ridiculous not to complete it and submit it. But it's also important to remember that our responses may elevate to an audit, as any of those that we just talked about, the types of audits where a correspondence audit could elevate again to an office audit or higher up to a field audit, depending upon the responses. Just to put things into perspective, related to exempt organizations, an example would be in 2008, the IRS launched its Colleges and Universities Compliance Project, and it lasted for more than 5 years. Results were started to be reported in 2013. So there were 400 colleges and universities in the United States that received this questionnaire. Of the 400, there were 34 that were selected for an audit. Primarily what we saw here was related to unrelated business income, as Michie had mentioned previously, being one of those, the income tax that's filed under the business income tax. So for the results of these audits, for 90% of the colleges that were subject to this audit resulted in a assessed increase in their tax liability. And what we saw most significantly was a disallowance of more than $170 million in losses. So this is just for 34 organizations, an impact of almost $60 million of taxes collected or requested to be collected as a result of this type of compliance check. So just to put it into perspective as to how something of this nature could escalate. Okay, I'm going to turn it back over to Michie to talk about some triggers.
So I want to start with individual and business triggers. How does an audit get triggered? Why me? Why is this a process? How does this happen? I thought I filed everything correctly. Sometimes it happens, right? And they're not avoidable in any instance because, like I previously said, the IRS uses computer programming to match up data. So there could be math errors. Again, if you're using a computer software, that should be, a very small instance. Those that are still preparing returns by hand, just make sure your software is always updated. A trigger, triggering it in the algorithm of the IRS's computer system. So the IRS literally has 3 layers of computer systems in which they go through and score, rate, and then produce letters to taxpayers in terms of whether they're going to be audited or not. And some of this is a lot of it is very sophisticated in what they use, in which they will not provide any information on how that first level of scoring an individual's tax return to then get it to the next level to see if there's any potential for unreported income. But the higher your score in the first system, you're going to be moved on to the next system, and you could potentially be triggered in terms of looking at what. And a lot of the information is just based on the population. So if you are an individual and your your adjusted gross income is $100,000. In their mind, they have an average of, okay, well, an individual in this situation, in this state, we would expect this amount of deductions from. If there's any variance in that, you might be kicked into the next level of scanning. And even to the point where some of these algorithms are so scientifically calculating your return and to make sure from third-party data, if you're claiming losses, how are you able to fund those losses? Are you spending more than you're generating in income? So does that now mean you have unreported income? So there's definitely things that we call it a red flag more than we do a trigger. The next bullet is just reporting income that does not agree to the IRS records. So individuals, if you are a self-employed individual, businesses that you're receiving your 1099. So now you're not only receiving a miscellaneous or a non-employee comp 1099. Now there's these 1099Ks. Don't just toss them into a pile. You want to make sure that whoever is sending you, that third party that's sending you that 1099, make sure that amount that they're reporting to the IRS is correct. For whatever reason, your return has X amount in gross receipts, let's call it 100,000, but the IRS's 1099 show that you're supposed to have 150,000. Well, we've just triggered some type of notice from the IRS. So you want to make sure that those are right. If they're not correct, you need to go back to your third-party vendor and say, listen, we need to work this out, because you could trigger an audit just because of that. If your taxable income is very high or very low in comparison to maybe your prior year, why did you have that bump up in income? What would they look there is in terms of, did you push income out into a year you weren't supposed to? If your income is very low, again, that's the algorithm. How are you able to fund your expenses if your income is that low? There are certain deductions that if they may be higher than average for what they would consider for a business or a taxpayer, some years it happens. As long as we have the substantiation and the reason behind those deductions, we're okay. Will it not trigger an audit? No, I can't guarantee that it won't, but we have the documentation saying it's okay. So don't be afraid to report all of your deductions, because if you're entitled to them, we want you to be able to take them. What we don't want you to do is put one line item and say business expenses. That's not going to help the situation. We don't want to have 1,000 different expenses listed on your tax return, but we want to make sure that as an average business or individual taxpayer, that we're breaking it out so that there's no undue stress of getting that notice saying that you're going to be audited. Claiming certain credits, especially those that are refundable, that could definitely trigger an audit. Right now, I would say between the earned income credit and the recovery rebate credit, which is, I didn't get my stimulus check, so now you owe me a credit. All of those returns are they are held right now by the IRS. There's no status. We can't give our clients updates on them because the IRS wants to be able to match that up and make sure those are all correct. Another very big one that has the most penalties in terms of $10,000, $25,000, $50,000 penalties is owning international assets and reporting international income. Here at Lumsden, we have a great international division, and they really do their job to dot the I's, cross the T's, because one form could cost you a $10,000 penalty, or not reporting one bank account could really create some issues for you. And then self-employed individuals, again, these are the small businesses. They're going after them. They're making sure that you're reporting everything properly based off the information that they have, especially if you're a tax basis taxpayer. They are going to be looking at that and scrutinizing it because they feel it's low-hanging fruit. So those are just some triggers that will occur on the side of, there's obviously so much more, and it could be in so much more in depth. As you work with your tax professional, we will give you some insights on what is appropriate, what deductions we can take, what documentation you need to maintain. But these are really the top ones that, go through the system and we see very frequently.
Okay. So I'm going to highlight some areas specific to nonprofit organizations including just some that are going to be similar with individuals and businesses. The first point, information on a return that appears to be inconsistent or incomplete. So again, they're going to look for significant variances from the prior year to a current year return, or if you're just missing information. So these returns that are filed by nonprofit organizations, again, this includes anything that is in part of the 990 series, so those annual filings with the IRS, but it also includes any reporting required related to your payroll, so your employee compensation, so those are quarterly reports as well as your annual report, and then your 1099s as well. This information has been aligned on the Form 990 to agree to the calendar year reporting. So in prior years, if you were disclosing the number of employees that you had, if you were a fiscal year filer as an organization, then you wouldn't be able to match that information, as well as the compensation of your officers. If you have any board members that are compensated, whether through that organization or a related organization, including those that are considered to be highly compensated and key employees. But all of that information is required to be filed on the calendar basis now. So they are able to match that information. So they would look for any errors that they would see here. They may receive a complaint from the general public or a federal or state regulatory agency. So we know organizations, nonprofit organizations, best practice is to have a whistleblower policy for the organization itself to be alerted if there's any wrongdoing. But it also is true for the IRS. You can think of a disgruntled employee that may contact them and indicate that you are not being compliant, whether it's to not reporting the correct activity, not reporting taxable compensation. And there may be other agencies that are responsible for oversight, but feel that it would warrant examination by the IRS. There may be issues with transactions with other taxpayers. So Michie just spent some time talking to us about the act that was passed in 2015 to allow partnerships to be audited and to have to report that information on those returns. Well, we quite often see that exempt organizations will be invested in partnerships and will have reporting requirements. There's flow through information that would be reported. You may have, it may be a partnership that's being audited that could indicate that there are some transactions that are suspicious transactions with a nonprofit organization. It could be one that the nonprofit organization is conducting business with. It could be someone who's a board member of that nonprofit organization. A nonprofit organization or these exempt organizations with 990 filing requirements have to report their transactions with interested persons. So if they're engaging in transactions, again, with, for example, a board member, those certain transactions do meet a reporting threshold, and that information is made readily available to the IRS. A claim for a refund or abatement might require further review. As Michie indicated, just because you've received your refund, that's a good faith effort, but it doesn't mean that your tax year is closed and you can move forward. The IRS can do a look back of 3 years, I believe, and then it could be additional. If there was significant errors in your reporting, it could expose you to additional tax years that you have filed. And what if you're not filing a return, but they're made aware of either they think that you should have filed a return, maybe you received a revocation, but you're still conducting activities, which a revocation of your exempt status, you can continue to perform activities, but then any income generated would be taxable. So just some things to keep in mind that could trigger from a nonprofit or an exempt organization perspective. Next, preparing for an IRS tax audit. I was going to try to pass that off to Michie, but I'm supposed to talk about this. So this is scary. If you receive a notice from the IRS, a lot of you, as Michie said, maybe you want to do the same thing you do with a 1099 and you just want to pretend it's not there or throw it off to the side. You want to immediately open and read the correspondence. Identify what it is that they're asking you to do. So we just talked about the different types of audits. It could even just be a compliance check-in, but it's very important for you first and foremost to understand what it is that the IRS is requesting. Seek assistance and clarification from your tax advisor. You may not be required. So we talked about the correspondence audit, where it's just a request for information to be sent to the IRS with an expectation that there may not be any direct correspondence with an IRS agent. But you still want your tax advisor to know what is going on, what is being asked, and to assist you through this process. So you want to review the information document request, so the IDR. So that is going to contain all of the information that the IRS is asking of you. So you want to gather that information. You want to verify that your books and records are complete. And if you can identify an error or missing documentation, at this point, again, is where you rely on your advisor to guide you in this to determine what the next steps should be. You only want to provide the information requested, and including the tax return for the tax year under examination. This is why it's preferred if you get a correspondence audit that you don't have someone asking you questions. As Michie indicated, it may take a couple of years, maybe a few years, to be able to train to get these IRS agents to the level of what they're replacing from the significant decrease we saw with retirements. But they are trained to get you to talk and to talk about things you shouldn't be talking about. So again, we'll go over some tips for a successful audit that will give you some guidance in this area. But again, you do want to provide the information that's requested, and it should be neatly and organized based upon the IDR. So you don't want to overshare, but you also don't want to withhold information. So again, even if there is an error or missing information that's identified, being upfront about that and not trying to be tricky is going to help you to get through an audit. There's also, the IRS makes available to the public their audit technique guides. Those can range starting from maybe about 40 pages, can go significantly higher from there, but it is actually essentially the manual that the IRS agent has that they will go through, and it shows you all of the items that they're looking for. It provides examples based upon prior rulings, regulations that are available. So it gives the agent a guide as to where to look, but it also gives you a guide and your tax advisor as you're going through that IDR to understand what it is that the IRS is looking for.
And Sarah, if I could, before we go to the next polling question, those audit technique guides, they even have them that are industry specific as well. So that's also very helpful to know what they're going to hone in on.
Very specific, even within the exempt organizations, it goes into the niches. So educational institutions, colleges, et cetera.
Okay, so we're going to move on to our third polling question. And how did you or would you feel if and when you received an IRS audit notice in the mail? Lots of emotions here, people. While we wait for everyone to answer the question, this question is really important because it really does pull out and show the emotion, the fear that people have in receiving, correspondence from the IRS. I've gotten it personally, and I'm a tax professional, and it's one thing to get it on my desk in the office. It's another thing to get it on my kitchen table at home. But the last thing you want to do is not open that and leave it and have it buried, and then still have additional notices that are still going to be generated and sent, and then they keep getting nastier and nastier. Oh, I love it. 65% of us are confident our records are clean. That's great. But this really shows you that there is emotion in just getting that. There's a fear out there in terms of what are they going to do to me? Why? But that's what we're here for. We're here to let you know that the IRS isn't always right. And we're here to help you. And obviously we guided you to get you to the point to file the return. So how do you manage the IRS audit process? We've kind of talked about already, how does this happen? So the IRS starts in terms of, hey, we're gonna go through a selection process. Most of this is computer programmed. There'll be a list for an actual human to look at in terms of, does this really need to be audited? And do we need it to be correspondence, field, or office, as Sarah has already told us all the differences between those audits. So then we get to, okay, what is the type of correspondence that the taxpayer is going to receive? Usually it's a soft feel, hey, we're looking at this is unreported, give us a call, you're under audit, and you have 30 days to respond. From that time, we definitely suggest that you get your tax advisor involved. Try your hardest not to be the one that directly responds to the IRS agent. As Sarah noted, they are trained to get more information out of you than you do need to provide to them. You always want to make a good first impression, and you do that by getting your tax advisor involved, handing over a nice clean set of everything that they ask for. I've always found that when it's nice and neat and organized and you're almost kind of doing the job for the IRS auditor, that it goes a lot smoother. Things are tied out. You never want to bring in your garbage bag full of receipts and dump it on a desk. That audit will never be done within a timely fashion. Again, we just talked about emotion. No one wants to have to know that their IRS audit has gone on for 6, 12, 18 months. Why? Why does this keep going on? So after you've made first contact with the agent or sent in the first amount of information, the agent's going to go through, they're going to perform their audit, and that doesn't mean that they're not going to request additional information. That's just their first ask. And also sometimes that, like Sarah said, if you don't have everything, we might need to ask for an extension of time. Oh, we need to get this 1099 that we don't have it. We had it, but now we don't. So we always want to make sure that we're following up with the auditor. If we haven't heard from, I like to make sure that I'm being annoying. Okay. So if I haven't heard from the auditor within the 4 weeks that I sent the information in, I give them a little nudge and say, hey, how did everything look? Do you need everything else? Because again, this is emotional. People don't like to know in the back of their minds that the IRS is out there still auditing them. So then there might be additional requests. There might be additional questions asked about the information. But again, you don't overshare. If you're asked to provide a statement, you provide the statement. Then they are either going to say yay or nay and ask more questions, or hey, done, we got the statement, we ticked it off, we're ready to move on. There's a lot that does go on, and I don't want to get overly technical within the process that happens between tax advisors and the IRS agents. But there could be instances where there is going to be a dispute over a tax position. And that's where there's a lot of rights of taxpayers. There's a lot for the tax professionals to really fight for the favor of our taxpayer and the positions that we've taken. So while it just seems as though this is, an easy handing over information, we sometimes have to get into the weeds of the IRS code and really show the IRS agents why the position was taken. And guide them through our process. And like I said before, the IRS isn't always right. A lot of this is just generated off of computers. So you really have to make sure that your professional is involved, especially if it's a higher risk position that's being taken. So from there, the IRS agent will conclude and provide you an examination report, proposed changes to your tax liability. There could be some proposed changes, there could be none. Hey, you could be the lucky one and you're getting a refund back from that audit. So that's really where your tax professional squeezed out some more. Maybe you found some more receipts. I've had that happen where, once the client started digging back into their records for an audit, they're like, hey, I found this whole folder worth of receipts I forgot to include. So you know what, why don't we just include them in? But that's really not the final say. Sometimes these things don't end very nicely. You have 30 days to approve or disapprove the proposed changes from the examination report. If you disapprove, you can try to compromise with the IRS agent in terms of, hey, I get it, we'll get it right. We'll get it right going forward, or no, we really don't agree with the position and we have all of our justification on why you're wrong. You may need to appeal the result, and there you would end up in some fashion into a tax court, to really make sure that we're fighting for the rights of the taxpayer. I would say I've been lucky enough, I haven't had to go to appeals for any of the audits that I've dealt with over the last 18 years. But it is out there, and it is possible that could happen. One of the things, when you do get your IRS audit letter, included in that is you're going to get the Taxpayer Bill of Rights. This is the IRS's first publication of their, 600, 700, 800 publications that they have out there. And it gives you your 10 rights as a taxpayer, that you are able to be informed, your duties to make sure you're paying all of your taxes, and also informs you of your rights throughout the audit process. One thing that it's an interesting situation, and I've had this happen with a couple clients, is that the IRS, sometimes there's a repeat examination and you get a letter, and if the IRS has already audited that specific instance within your tax return, if they've audited in any of the previous 2 tax years where they did not propose any changes, so they audited, there was no change, and now they want to audit you again, like, come on, put us through the ringer here. We can go back and ask for that examination to be discontinued because you've already audited it, we've already showed you that it's appropriate. Now you're just really, wasting the time and efforts of not only the IRS, but the taxpayers. So repeat examinations can happen. And again, because a lot of this stuff is computer-based. So now we're going to talk about some tips for a successful audit. And we have touched on this a little bit along the way, but really the bold is on purpose. We don't contact the agent. I know 65% of you are so confident that your books and records are clean, but they're going to ask you that one question about, hey, I see you got a company vehicle out there. Do you take that home with you? And you're like, well, yeah, I can. And they're like, oh, personal use of vehicle. So those little questions out there that, they are trained to ask you, that's where, and sometimes you do have to sit in on those IRS interviews, and your tax professional will train you and let you know what you should answer. Or there's always I'll handle that question, Sarah, just because we know that you guys want to be upfront with the IRS auditors, but again, don't overshare. Don't delay in responding. We know it can be burdensome, but why drag out an audit if you don't need to? If for some reason you are having trouble getting your records together, we can definitely request extensions. Do not provide more information than requested. Do not withhold requested information. There's got to be a really good reason that you don't have it. And if you don't have it, really expect that that's going to be thrown out and you won't be able to take that deduction if you don't have the substantiation. And please do not treat your agent with ill will. That's our job to handle that process. This is only their job. This is what they're supposed to do. And if you start off with a bad impression or treat them poorly, we kind of know which way the winds blow in that audit. So treat them with respect. They're doing their jobs. So those are just some general. I know we're getting a little short on time, so I'm going to just kind of wing through some of this. Individuals report all of your income, have substantiation for all of your deductions, keep them together. In the world of paperless and scanning and taking pictures with your phones, you can really have all of that digitally as long as it is a copy of the original. You don't have to keep all the paper copies of everything. Even the cash register receipts, right? You go back to return something 2 years later and all of the ink has disappeared off of the paper. Like, what happened to it? That can happen for your audited receipts too. So, scan them in, take them, save the file somewhere externally, and you can be done. Retain all your tax information and documentation for at least 7 years. The statute of limitations is 3 years from the filing date. But if the IRS feels that you may have substantial understatement of income, they can open up 6 years for your tax return. So be careful there. And for business owners, this is going to kind of sound almost similar. Reporting all your income, substantiating deductions. Business owners, there are a lot of deductions that may have limitations to them. Understand those limitations, report them properly. One of the biggest trigger areas that I've seen in all of the audits I've had in the last 3 years are gifts to clients. In 1962, the IRS decided that $25 was a great allowance for you to be able to give a gift to your client per year per client. In 2021, you still can only give $25 of a gift to each client that's deductible. If it goes over the $25, it's not deductible. I've done some great research in this area in terms of, let's say you want to send flowers out to your client, shipping charges, delivery charges, they're not adding value to that gift, so it doesn't count towards the $25. Meals are limited. Right now we're at 100%. Entertainment has been limited over the years from 50% to none. This wonderful parking limitation that they have now. De minimis safe harbor expenses. If you own a property and you don't have audited financial statements, $2,500. If it's under $2,500, you can just expense it. You don't have to capitalize it. Owner benefits. These are all the small things to get right so that when you do get audited, you can show we did make a good effort, that this is everything. And again, keeping all of your original receipts. Yes, you can use a business credit card. Do not commingle business and personal. As soon as you do that, as soon as they find that one transaction where you paid something personally out of your business credit card, well, now you got to pull your personal information into your business audit. And your credit card statement is good for the first round. Then they're going to ask you for the original receipt. So whatever you bought off of PayPal, that office chair that you bought, and do you have that original receipt? They're gonna want to see it. You can't just use your credit card statement for substantiation for expenses. As Sarah's mentioned about filing your information returns, understand what 1099s that you need to file. I know it's a hassle. I know it's information. There's no income taxes due, but this is how the IRS bases their audit pull off of. File all your payroll taxes, tax returns, make sure what you filed actually agrees to your business tax return, and file your sales tax returns. Again, make sure that they agree to what you're filing on your income tax return. And I think we're getting a little tight on time here, and retaining your information. So I'm going to hand it over to Sarah.
Okay. On the next slide, we just have tips for a successful IRS tax audit for nonprofits. And it really just goes back to what Michie was saying, where you have substantiation for your activities. So we've highlighted some of the areas here that are closely scrutinized. You can see that they're related to compensation at the executive or officer level, proper identification of employees versus independent contractors. This is true for all entities, not just exempt organizations, properly reporting compensation for your employees, maintaining analysis of just supporting why your income is part of your exempt purpose, and then allocated expenses if you do have taxable income or unrelated business income, understanding allowable activities. You don't want to lose your exempt status, which revocation is something that could occur if you're acting outside of the limitations of those activities. And then again, just ensuring compliance with state laws and regulations. And we'll quickly turn it over now because we do need to fit in 4 polling questions. So this question, do you know of an individual, business, or nonprofit that recently received an IRS audit notice?
And as everyone's answering that polling question, Sarah and I are just going to go through real quickly just some general IRS audit myths that just aren't true. So Sarah, you want to kick us off?
It's the IRS. They are always right. I'll just pay it. So I think we already covered that.
Filing an extension means you will get audited. I have no idea where this myth came from. It is not true whatsoever. There is no data to prove that filing an extension will cause you to get audited.
Only large businesses or wealthy people get audited. False. So Michie just talked about the initiative where there's going to be a focus on small businesses.
I use a tax professional, so I won't get audited. Sorry, I do 110% make sure that your return is great, but you know what, those computer programs, and again, the IRS not always being right, there is that potential. So please give us the benefit of the doubt that we did file everything correctly, and we will communicate and get that fixed up for you.
I received my IRS refund, so I am in the clear. So as we have talked about, it is a good faith effort that a refund is provided to you when your return is received, the majority of the time. But again, you still are subject to examination.
And I should understate my deductions so I don't get audited. You need to report your fair share. Paying your fair share means if you have deductions, you have deductions. If in a year it's higher than it was last year, as long as we can substantiate the reasoning why, we will claim those deductions. Don't ever fall short of claiming what's owed to you as a taxpayer. And just as our overview, the IRS is ramping up. How quickly we're going to see these audits, we're really not sure. And again, all of these auditors have to be trained. So I do think that anything that comes out in the next year or two may be a little bit painful to deal with. Audits are not avoidable. I'm sorry, the algorithms are just not in our favor sometimes. Seek assistance from your taxpayer, from your tax advisor. Be prepared, keep full and accurate books and records, and be cooperative, but don't overshare. Maria, are there any questions that we can answer quickly?
We do have a question. So if I heard you correctly, you can't use your credit card statement as proof of a business expense. Example would be a gas receipt.
Correct. You can use it in your initial, to be able to show the IRS that it matches up to your GL detail. But if they specifically go in and say, okay, on July 14th, you filled up and you spent $200, can you please show me that receipt and tell me where you went? They can ask for that additional documentation. So you do need to keep those original receipts.
Okay, great. I hope that answers the question. If anyone has any other questions, you can put them in the Q&A real quick. Otherwise, we will wrap this up. As I mentioned previously in the chat, we have Sarah and Mishy's email addresses, and of course you can contact them via our website. And we will close it now. We'll send an email, like I said, with the recording. If you have any questions, please reach out. And again, thanks for everyone for joining us today.
Thanks,
Thank
everybody.
you.